Hi, Tom Quinlan. Nice to see you all. Thanks for coming. We have a little panel here that's already been talking about things they can spar about, so I'll introduce them. Down with the CAF, we have Glen Anderson, who is the President and CEO of RainMaker Securities, full-service merchant bank, is that required?
That's right.
Cool. But before that, you've worked in institutional equities at Oppenheimer in New York and Jefferies here in San Francisco, focusing on the TMT sectors. You've worked in venture capital in Europe, which must have been an adventure, and the hedge fund industry in Chicago, where it's a hometown sport. We have Matthew Merle, who is with Fifth Era, but also I know him through Keiretsu Forum, a veteran angel investor, and leader of their fund, as I recall. And so, Matthew is also a trustee and a board director of the Bay Area Council Economic Institute. Has worked with the governor of California on China issues, which we should talk about because I'm up to here with China lately. We through Keiretsu has a lot of experience and through Fifth Era as well with early stage companies and securities and has views on the current state of the secondary markets that we'll be listening to. We have Niraj Mehta. Raj he's a CEO of Kilowatt Capital, which is a private family office, which is an indication of how successful he was in his prior endeavors, where he was with, he was a co-founder of Persistent Edge, a private registered investment advisor with 1.5 billion in AUM, assets under management, that specialized in construction and active management of unique funds of hedge funds, not just funds of funds, but funds of hedge funds. So a little bit of a spin there. You also were a managing director with Redwood Ventures, where of course you focused on early stage tech companies. And finally, we have Sven Weber, who's managing director at SharesPost. I think we know SharesPost as being a mover and shaker in the secondary market. Before that, Sven was at Silicon Valley Bank in I guess in the Valley.
Yes.
Where you managed the company's venture capital investing business, which included direct, secondary, and fund-of-fund investments over 1.5 billion in AUM. There you go. So, with that, I want to mention my experience with secondary markets is twofold. One is back in the day, in the 90s and early 2000, I managed to have some clients that were having liquidity issues, and so a bunch of us invested, and I was able to pay for all of my kids' college tuitions through the exits that we made to PE seller or PE buyers a few years later. So I have a lot of respect for the secondary market. That's the only place I ever get to play, and it's the only place that I would invest after having a lot of information from the companies. But also, we work with a lot of financial institutions that do loans to executives and whatnot that are secured by privately traded or actually private shares, non-public shares. And so that's a bit of an adventure as well. For the panel, you saw, is it Manny or Manuel's presentation before. What's your view of the state of the market now in terms of activity? Can we continue to see an increase in the near term? And really, I'm also asking, what are you seeing in terms of valuations, and how do you think that affects things? We've seen a lot of stories, people valuing, discounting portfolios. I know even in our own firm, our capital markets group is scratching their heads and wondering, when they're actually going to get to roll out some of the IPOs that we've registered. What do you think? Glenn, what's your view? What are you seeing?
Well, so I guess there's a couple questions in there, right?
Right,
So,
it's about three. Just pick one.
all right, so the state of the private equity or secondary markets. I think there continues to be a lot of room for growth. And the reason is, right now there's probably 15 companies that we see traded with any depth. We believe the numbers are going to grow as more and more funds come into the marketplace for a lot of the numbers that you talk about. Is drawing a lot more interest by investors into the space. You're going to see a lot more investors coming in. They want to see more names. They want to see more get involved in more deals and more stories. And so you're going to see the market broaden beyond the Ubers and Pinterests and Spotifys of the world into a broader group of companies that are traded with depth in the market. So that's part of what's driving it. Second, there's more structures for people to transact. Forward sales are starting to become more accepted, for example. And employees are becoming more sophisticated about it. I mean, a lot of employees, a few years ago, employees didn't know that they had these options available. Now everybody's talking, they understand that these options are available, and they're going out and finding them. So I think there's a lot of growth, both in terms of the number of companies, the breadth of companies that are traded, and just in terms of the number of transactions that are going to happen. On the valuation question, I don't know if anyone wants to take that one. That's probably hot potato, but what I've seen here is actually, I think, is very positive, which is, in prior cycles where we've seen valuations come down, a lot of times the market goes into a deep freeze and you're just not getting anything. I think what we're seeing now is one more orderly adjustment to the market. We're seeing companies still get funding, they're just having to do down rounds. And you're seeing secondary transactions still get done. It's just sellers' pricing expectations are starting to come down. So I actually think this cycle, I'm a lot more comfortable with what I see in this valuation correction than what I've seen in prior corrections, which is I think there's an orderly adjustment going on. And I think it's good for the market. It's bringing prices into some, let's face it, some of these stories were very expensive. And now they're coming to, a lot of stories are coming down to a place where they become good values again. So, anyone else other than that?
I'll add something. So there's a portion of this that I think I understand and a lot that I don't. And so I won't talk about private equity. It's not a place where we play. But I do want to make some comments about the, if you will, the unicorns, the technology, the secondary market trading in highly valued digital companies. And I actually am of the view that now is a great time to prepare to do secondary market trades, but it's the worst possible time to do them. And I'll explain why very, very quickly. The way the VCs play this game, and they've done it through several cycles now, is they, in the off cycle, prepare their companies for this window when values are high, the IPO window's open, the corporate acquirers are acquiring, and they can get a very large increase in the value on what they invested. The reality right now is, if you look at these 200 unicorns, almost something like 80% of them will have to do additional financing before the end of this year. They'll run out of money. The IPO window is closed. The corporate acquirers on the sidelines because they're expecting values to decline substantially. Most of these companies are not cash flow positive and unlikely to become so. And the VCs have sort of fired most of their bullets. They can continue to put 500 or $1 billion into some of these companies, but most of the VCs are not likely to do that, though some of them may choose to. So, my sense is that the unicorns systematically before the end of this year will need to do a couple of things. The first is they'll dramatically have to right-size their businesses, which means fire a lot of people, preserve cash, stop spending like crazy, and obviously focus on getting cash in today by any means possible. And I think what we saw the last two times around is what that means for the Bay Area is, at least 20 to 40% of the unicorn sales workforce will be fired before the end of this year or early next. those people do have equity, and those people will be highly distressed. They will not be able to find jobs in the Bay Area. They will need to leave. And those are exactly the people that I would love, to get to know now, because those are the people that, we saw this last time round. If you show up with a little bit of cash so they can buy their plane ticket back to Kansas, they'll sell you this stuff. And then the challenge is, you only want to buy the survivors, and a lot of the unicorns won't be survivors. So that's the other part of the equation. You're going to have to see through to, it's a real company, it's going to survive. These people have downsized and have to leave. I want their equity.
I would.
I'm sorry, can you say the first part? You said 8% or 80%?
80%. CB Insights just sent out a very good little email on this, which didn't talk about everything I just said, but it did talk about this point where they looked at all of the unicorns and their cash flow needs and money in the bank and how many of them have to do a round before the end of this year. And the vast majority of them need to do that round probably around about the third, or in some cases the fourth quarter of this year, unless the CEOs bite the bullet and slash and burn right now.
Okay, just pass some views to it. First of all, the 80% doesn't shock me, because even in historic average financing on this day for 18 months, if I calculate it out, that gives at any given time 75% of the startup is looking for money. So it's 75 or 80%. This is not unusual level. And if I recount the CB Insights, it actually talks about 40%, but I might be wrong on this. So 80% doesn't shock me. I was positively surprised this morning by 40% are only 40% are looking to do that. Second, I agree with your general analysis, but I think the time is already now. I see already now, and for the last 4 months, layoffs 15 to 25% in these companies, and I already see now people selling in distressed situations. So I had some people earlier talking here and say, I currently as a buyer, and we deploy a lot of capital, I feel like a kid in a candy store already right now. Second, I also know by going through 2 cycles, 99, 2000, and 08, 09, that you can't 100% time the best time when to do that. You have to pace yourself. You have to see how much capital you want to deploy in an environment like this as a buyer. But you have to somehow continuously be in there, because you not exactly know when the point is there. The last thing in this, I think, is that a lot of people should underestimate how hungry the capital is in the public market to get into growth. If you're a public investor today, and the average growth of an S&P 500 company is 5%, and you have private late-stage companies that grow 50%, 75%, 100%, and a portfolio company growing 450% per year. If that is getting compressed by 10% points, that company can digest it. I agree with cost control, and I agree with not doing that. But the pressure on a company growing 50% by 10% points down is not as bad as 10% point on an S&P 500 company growing 5%. And we also have to think about this as a new asset class. And we have to separate these mega rounds that are $100 million or more from venture capital. These are not venture capitalists doing it. If you separate these out, the traditional venture capital goes up to rounds of 100 million. This is quite stable in how much it deployed. It only grew 10% year over year, where the massive growth was that gross hungry capital from the public side went into the private side, generated a significant amount of late-stage growth companies with mega rounds of 100 million, 500 million, $1 billion. They used to go public. You don't need to do that anymore. This is an own asset class that is separated from venture capital and that is separated from the public world.
Right. So we're agreeing on the fundamentals, but what none of us have still spoken about is the reality of the current valuations, and are they about to collapse by maybe, go down to maybe 20% of today's values. But I think we're agreeing on the fundamentals. Difficult times coming, a lot of people needing to sell, a bunch of companies in distress, an opportunity to buy. My point the other half of my point, which is the hot potato, is I think these valuations at which Fidelity started buying last year are going to collapse by maybe 80%.
So,
80% or
80, 80, I just threw that number out, but we saw it in the dot-com boom. We saw companies that even had sound businesses that were growing very, very fast, but a long way from cash flow positive, with the valuations just simply collapsed.
I don't know where to begin here. I can't even, I have about 10 things to say here. It's such a right field day of comments. So the first point I'm going to make is everyone here in this room, we are at a unique point in history, at a unique place in the world. It's very important to understand what that means. That is now facilitating things that were not ever possible to witness in terms of value creation in the timeline, being able to be done so. I'm going to answer a few questions. So first, I agree with most everything Matthew said. What I disagree with Matthew on, I agree with the 80% number. I agree the vast majority of these unicorns don't deserve to be around. I think there's going to be a lot of pain that's yet to be even touched on or experienced. Where I disagree is there is a small subset of those companies that do have enough cash on the balance sheet to go profitable or are already profitable. Now, when I say small subset, I'm talking about less than 2 handfuls of 200 companies. And those are, frankly, the only companies that I want to be long, if that, and I'm long 4 of those. And they don't need to raise their money. And they're wildly profitable. And they don't need to go public. And they're going to be incredibly successful businesses. But the art and the challenge for us on the buy side is to figure out who deserves to be valued at X billion dollars. And the reality is the majority who are trading around that on sympathy aren't just going to get cut in half. To everyone else's point, they're going to get cut. And they're going to be the Walking Dead for years, and then eventually they'll disappear. So whether it's, should they trade at 20% less or 80% less now, the market's going to figure it out. So I think that's kind of comment number 1. But the broader comment I'd like to make in talking about private technology equity financing, independent of secondary pricing, is let's go back in time 15 years. For those of us that remember 15, 16 years ago. In 2000 and 2001, the cost of creating a technology product and bringing it to market through a private startup was an average of $5 million for a Web 1.0 business to launch. Forget revenue, forget customers, forget product market fit. We're talking just getting the damn thing launched to market. So you had, and it took about 18 to 24 months. So that was old world. And again, you're guessing where the market's going to be a couple of years from now. And if you were wrong, how many more shots on goal do you have? Good luck. Today, fast forward, we basically have an order of magnitude less in time and 2 orders of magnitude less in cost. So it's roughly about 20, 30 grand and a couple months to get a product to market. Again, that doesn't a successful business make. It just means you've mitigated one aspect of the risk curve. That's kind of point number 1. Point number 2 is the markets 15 years ago versus now are several orders of magnitude larger and more readily accessible. In the old world, going back in time, market sizes were a function of PCs multiplied by the penetration rate, multiplied by the time spent in front of them, multiplied by the dollars flowing through consumer and enterprise markets. Versus today, desktops, smartphones, tablets, multiplied by penetration rates, developed emerging market maybe on the order of 10 to 50x more, multiplied by time, aggregate maybe 3 to 5x more, multiplied by dollars, all of our dollars flowing through devices now, maybe 100x more or more. So you're talking about 1,000x more volume markets for 1/100th the cost. What that means is the same dollar that went to a startup 15 years ago is leveraged on the order of 100,000 to 1,000,000 times more today. But the universe was only hundreds of companies back then. Today it's hundreds of thousands of companies. And then the final point I'll make on the big picture macro trend is in the old world, a successful outcome was a $1 to $2 billion exit through an M&A or an IPO. Think OpenTable, Zappos, PayPal in that generation. We had a dozen financing events over the course of a decade or a decade and a half. Today, a winner like an Uber, Airbnb, etc., is a $10 to $50 billion private valuation, but in 1/3 the time. And the dilemma we all have on the buy side now is it's not 1 out of 100 that's the successor. the successful outcome. It's 1 out of several thousand, if not 10,000. That's a successful outcome. Anyway, that's...
Well, I thought that was very good. So which of the 5 fast-growth technology companies that are already cash flow positive and are fairly valued that you'd say we should get into? Because I'm serious. I mean, I liked everything you said, but which of the 5?
That's for later. I'm not going to name any specific companies yet.
Well, you've got to front run your
Well,
position.
okay, fine. I would say that they're not the ones that I am long that may not necessarily be profitable today, but have a path to profitability, and I think are unique franchises. I'll name a few: Uber, Lyft, Context Logic. I think are unique franchise businesses that are highly visible, highly have significant moats around them. That if they're not cash flow positive today, have a lot of visibility to get there.
All right,
So
Just name a few examples.
Right.
I'm
No,
not
no,
naming all.
just, I think we need to,
Yes.
we need to fundamentally, I do a lot of valuation. Just because I run a mutual fund that is 100% investing in these private companies, and we actually do net asset value determination on these private companies every day. So, one important thing, I like aggressive statements like 80% down, and I might be willing to underwrite it if you say it is on common stock. But what people really don't understand and often just go out with a very wide brush and not differentiating between the different classes of stock in a company. It looks totally different if you own preferred. And let's take Uber. I might a little bit disagree with your view on Uber, but I think the ones that are really in trouble on Uber are the common shareholders.
Yes.
Yeah, sure. Because the preferred shareholders, they get their money back and are in profit at an exit event of 4.7 billion, and not at 50 or 60 billion that a company is valued at. So it all depends, and it's very important. I'm on records for a year now that I say some of the valuations you scratch your head on, but you have to understand the internal structure of these companies. Where do you go in? Which company, at what price, and which security? You have very funky things in there, and who's getting what price per share. And we see exits out there, people are writing about it, where the preferred shareholders go home with a profit, and the stock option owners or the common shareholders who bought their exercised their options for tax purposes are suddenly underwater.
Yes.
You have to understand the internal structure.
We
I underwrite you 80% if you talk about common stock.
Yes, so
I don't underwrite this for preferred stock.
So let's double click on that, because I agree that's an important point, which is the majority of secondary market positions you'll be offered will be common stock. Why? Because the sellers are employees and they own common stock. So now, which of the 5 tech unicorns close to cash flow positive where you can get into the last round and avoid all the liquidity preference and the ratchets the VCs have negotiated for themselves? Because I don't even know how to gain access to those companies.
So I have 50% of my transactions are preferred.
Yeah, I was going to say, you can buy preferred shares all day long in the secondary markets.
Yes, but the other half of the equation is, fast growth tech company close to cash flow positive. Which of the 5?
I have 35 of them out of 35 in my portfolio. Just go on the page.
Close to cash flow positive. They're not unicorns. There is, like, you mentioned Uber. Uber just raised 2.2 billion.
Sure.
It's blowing through about 500 million per quarter.
But Uber is, what is this? This is I can't even call it a unicorn. This is something.
Just
we
put
can
that
talk
into
about
context. Talk about cash flow negative. They're burning 2 billion per year.
Right, but if they wanted to be profitable, they could. You have to understand, like, the curves
I'm
of what they're
I'm
doing.
not defending Uber.
Yeah, I mean, I can talk about Uber until the sun comes out. It's a generational business that we will not see again for a decade. I can tell you that unequivocally, not just because I'm long, but we will not see a business like this. And I think it will be, in 5 years or more, one of the most valued companies in the world. And I think it's raised not to become a Google, Facebook-sized business if they don't screw up. And I think that's the path of least resistance. And that's not explaining the market value of the current multiple. I'm saying that the multiple could get cut in half or even more, and there's still going to be several multiples of where they're valued today. Because of the strength of their business, because of the moats because of the fact that how many people in this room used an Uber or a Lyft today? Alright. How many people have dropped a car in the last 2 years because of Uber or Lyft? Okay, I have.
Cool.
That's a market size that's a lot bigger than taxis and town cars.
Yeah. The last 2 weeks I was in Seoul, Delhi, Chennai, Singapore, Jakarta, and Bangkok. All of them are in the process of banning Uber. So there is a global phenomena to re-regulate the on-demand services, and Uber and Airbnb are at the center of that maelstrom.
Agreed.
So I don't think they're out of the weeds, and they're burning $2 billion of cash a year.
Again, I think we're not here to discuss one company.
Yeah.
Again, this is absolutely on his side. This is 50 to 60 billion for common stock is nuts on this company. And but
Get preferred.
you have to get. If my philosophy is the moment you reach $1 billion enterprise value, you need to get preferred.
Okay.
If you look at the historic average of exits, you have to, what is the historic average of liquidity events and enterprise values? You have historically, and it didn't change, even though people were talking about, oh, the market is heating up and so on. I didn't see a change. You have 8 to 12 liquidity events, IPOs or acquisitions per year of $1 billion or more. So if this is your exit universe when you invest and come in with a cost base of $1 billion or more, your probability space of an exit in the next 3 years is very small. The vast majority of companies having $50, $100, $150 million in revenue, when this is the kind of profile we are talking about, their exit enterprise value and the liquidity event is 300 million to 900 million. So you have to get your cost base against that and then take $1 billion plus as something that is nice to have. And there you can play and look carefully what you can do on the common stock versus preferred stock. But the moment you hit $1 billion, you better get preferred stock.
I don't disagree. I think cap tables are now going to start getting utilized a lot more in this environment. We're starting to see a lot more ratchets and make-whole provisions and liquidation preferences. So yeah, I wouldn't want to be long common exclusively either.
I think everybody here at the table is in one way or another saying the same thing, which is on the valuation question, are some companies expensive? Yeah. I mean, by any metric you can think of to really value a company, yeah. But do some companies deserve premium valuations? Yeah, they do. So, I mean, almost every company that is a growing business, it has a value. It's just what is that value? And I think you have to look at each individual story and decide for yourself whether you believe the prospects justify the type of premium that they're getting in the marketplace.
Now, in looking for that story, where do you find it? Where, in the public markets, there's a lot of transparency, just by law. In the private equity, in the private markets, rather, what are the sources of reliable information about, cap tables, preferences, that sort of thing, and what role do the exchanges and groups like SharesPost play in that process?
For us, we obviously transact in a lot of different names. Every trade is different. I mean, it depends on, if you're participating in the primary, you have very good information typically. So if you're an investor in investing in Uber's primary round or Lyft's primary round, you'll have very good information available to you because it's primary. Certain sellers of their secondary, in a secondary, maybe they were a very early investor, maybe they're just an important investor to the company. Often they can get information, right? And we can take it. The investor benefits from that access to information. And in some cases, it's an employee, seller, mid-level engineer that doesn't have any information to give. You have to rely on what's out in the public sphere. But the nice thing is, actually, there's a lot more information out there than there used to be. 3-4 years ago, you get damn near nothing on a lot of these companies that are being actively traded. Now there's a lot of information information, and it's been a derivative of the growth of this marketplace. There's a lot of information service providers out there that now provide sources of data that are pretty reliable about these companies. I don't know if anybody else has anything.
Question? Michael, can I ask a question?
Matthew,
Go ahead.
On
Mike, you brought up Fidelity before. Today's Journal identified that 13 out of 26 investments they've made in unicorns have been marked down well below what we call a strike price, the original investment. My guess is that the average has been, from what I've seen in other resources, 30 to 35% to date. Okay. So I just want to add that as data, current data for your comments. Second of all, did you make a comment that VCs are putting $500 million to $1 billion into unicorns?
Well, so Uber raised, I think it was 2.5 billion, of which 2.2 came from China in their most recent round. So, yes, it's unbelievable.
VC fund.
Well, so the question is a VC a VC a VC? I mean, today's VC, last year the VCs invested $72 billion. Of that $72 billion, only 1.5 was seed or earlier, so they're not venture investors anymore. And of the 72 billion, about 40 billion was actually pre-IPO funding of their unicorns. So that 40 billion that the VCs invested wasn't venture investing at all. It was pre-IPO expansion capital. And that's the game these VCs are playing. I think they're playing it very well because the same GPs who run those firms today also ran them in the dot-com boom, and they understood that they left all the money on the table for Wall Street. This time round, they've taken the Wall Street money off the table and held on to it themselves. And I think they've done it very well. By the way, I'm not negative about secondary market trading. I just think that you need to be the person on the table who is not distressed, and you want the other person to be as distressed as possible. And I think by the end of the year, there'll be a lot of very distressed sellers. And then the challenge is, do you believe that it's them that are distressed, not the company? And that's very difficult, because you need to make two good decisions. The first is, the company's not distressed, and the second one is, but you are. And you've got to get both those things right, and then buy at a very deep discount.
Okay, and that's not very popular at Silicon Valley cocktail parties.
Well, that's where the big money got made, if you weren't Sequoia and Kleiner, in the dot-com boom.
As the press is doing a little bit out of the Fidelity thing, and you're mentioning it, so just some statistics. First of all, in these late-stage growth companies, historically, you have a write-down rate of 35%. So if your expectation is that every of these companies and every single company is successful, will always be having markups, that's wrong. 35% of these companies have historically shown write-downs and loss. So that's to start with. So 35 is not something that shocks me. Second, I'm taking Fidelity, T. Rowe Price, BlackRock, and every reporting. I take them apart every day. The moment they are reported, we have to analyze them to see if did we miss something as another mutual fund, which is public, and we also do public reporting. So what turns out that Fidelities and others are doing, actually, they're investing out of a discretionary bucket with a non-material position. So they're having some kind of a freedom on the U.S. GAAP accounting and how they take it in. And to be honest, Fidelity and others oversimplify how they calculate it. They're not taking into account the differences for the preferred stock they own. They own preferred stock with liquidation preference, which means that there's an M&A scenario, a minimum return guaranteed to you. They are not accounting for that. They've just taken enterprise value and divided it by the fully diluted number of shares, and not taking the internal structure of these things into account. And then, of course, you generate by that discounts. That's why common stock is performed or has this thing, because they're treating preferred stock like they would treat common stock, which they can do because it's a discretionary bucket in a non-material position. They can just pick one method and say, that's it. So you should discount that. Second, Fidelity has securities, the same security in the same company in two different funds. and they're valuing it at a total different price per share. And the difference is not minimals, like $6 per share versus $12 per share. So which one is true? Yeah, but it comes back again to the point is that they have some freedom on the US GAAP accounting in how they can do that. The spread between the mutual funds is significant in how they look at these things. So we should not jump to conclusions in how they market, because they are more focused on a 95% main investment strategy that is holding up, and they can just take losses as they want to do. And 35%, 40% write-down rate is what we should expect into starters. Not every company at that stage will just go up in valuation all the time.
I have one comment to make on the valuation side. I think it's very important to distinguish the data between the stage of company, because if you go back in time, let's just go back the last 5 years, you can find a lot of open source data. What you'll see is the late stage, which has seen the most influx of capital because of the mutual funds and hedge funds and institutions not wanting to wait to buy companies at 100 billion valuation, are now been going into these late stage private rounds. You've seen on average a valuation lift from $500 million to $2 billion over the last 5 years. Whereas, for instance, where we're most active, or I think Matthew is also most active, is in the seed stage, where in the corresponding time period, the valuation change has been from $4 million to $6 million. So you tell me, is there a quote-unquote bubble or not? It depends on where you play. So a 400% lift versus a 50% lift during the exact same time period is a very different situation. And I think that's not what a lot of people look at.
So let me argue the question from a completely different point of view, right? So, and the question here, but it will still come down to the point of what's the duration of your hold and when would you begin it? When would you make your purchase? So we know that California, Northern California specifically, is a boom-bust economy. The Bay Area Council Economic Institute can track those cycles for 150 years. The state of California completely relies upon Northern California for tax receipts. So we know that 40% of the current receipts of California come from Northern California, and those are capital gains related to IPOs of technology companies primarily. We also know that every time we are in the bust part of the cycle, the tax receipts for California dry up, we go into a big deficit, and the state is close to bankruptcy. So given that, this cycle, you can see it on charts. Sean Randolph has the cycle. Just bear with me. Just believe that there will be a downturn. And the thin end of the wedge on that downturn are the pre-IPO tech companies of Northern California, every time. So then, how long do you plan to hold them, and when would you buy them? And what I'm trying to proffer to you is, you would try and catch them on the downslide, the ones that you think can be good, and can, because unless you're going to try and only hold them for a month or two, you're going to be faced by that. So that's what I'm trying to argue. I'm saying absolutely prepare for secondary market purchases, look for distressed sellers, but the distress is not quite here yet. I think the distress is end of this year, early next. But maybe, I'm curious if anyone in this room thinks that there will never be another bust in California. Right? Because if then it's just a question of wait. Get your cash ready, have that pot ready, and just wait. It's going to happen. We're Californians, we know that. It's 150 years of a cycle. And it's coming.
Clearly the cycle is here.
You think it's already here?
I think it's already here. I think you're 3 months into it.
I haven't seen one unicorn go bust yet. So how can
there's several.
Which unicorns have gone bust?
Good technology was the first one.
Oh, that was old.
That's a fire.
Yeah, but it was valued. It was sold.
It was sold to RIM, but it was a
Yeah, for 400 million, and it was
I wouldn't call that
1.8 billion.
I wouldn't call that a bust, though, would you?
1.8 down to 400, and the common shareholders went down to nothing.
That's separate, yeah.
Well, there's 200, so one would make a bust. One would just be as you say, it would just be the normal statistics playing out. A bust would be 50% or so of them going under.
You have a
We're in
question?
a,
Yeah, but a
we're in
cycle
a
and a
bear
bust are
market
two
for
different
secondaries,
things. Yeah.
basically. And this is sort of what I said at the very beginning. We're in a bear market for secondaries, or we're seeing valuations adjust. But what I'm seeing here in this cycle that makes me feel a lot more comfortable is it feels a lot more orderly than it was in the past. You're seeing a lot of down rounds. Companies are still getting money, but you're seeing down rounds. Secondary markets haven't dried up. There's a lot of trading going on. We're seeing it. We're part of those trades, and you're just seeing trades happen at lower prices. So I think the secondary markets are starting to develop into a marketplace like the public markets that can correct, and transactions are still happening, right?
Hey, Glenn, let me ask though, what we saw, we talked a little bit about the dot-com bubble and whatnot. In the dot-com bubble, a lot of the crash there was, or the drama was around the failure of the public markets. Around, you talked about, Raj, you talked about how quickly or how long it took to launch a company, but it took less time to go public, I think, back then than it does now. And so, now we have private markets. Question is, do we see the same, I don't know, let's say unsophisticated people playing in the secondary markets that we saw in the public markets for .coms? And does that affect the volatility?
It's very different. I think what you're seeing now, again, I think one of the other things you're seeing is the IPO market has a lot more scrutiny now in terms of what goes out there. All of us went through 1999 and the garbage that was going public with no business model, basically a website and an idea almost, and getting obscene valuations. That's not happening now. We're seeing real businesses go public. And I actually think Square's, a lot of people bellyached about Square, but I thought it was a good test case for the market because, look, Square is a business with its own challenges. It was in a secondary bear market for 2 years before it went public. We saw the prices coming down in the secondary market. And when it did its IPO, I wasn't surprised at all at the performance. Public market accepted it how I thought they would accept it, with some skepticism. So I think Square was a corner case.
So let's just talk a bit about the Fidelity Mutual Fund Manager, because I think this is important to understand. So in the dot-com boom, well, firstly, if you're a mutual fund manager for one of the world's largest asset management firms, my wife was CFO at BGI, $4 trillion under management, you get compensated if you outperform your sector by 1%. You are a superior returning mutual fund manager if you outperform by 1%. So those guys sitting in Boston and New York and so on, they basically say, look, I have a sector. I manage Fidelity's money in the technology sector. I have IBM, HP, Cisco. Those things are not moving very much. If I can turbocharge this with a little bit of IPO uplift, I can get that 1%, and I'll be the most famous mutual fund manager in the world. Then they say, in the dot-com boom, the typical average spike post-IPO in those stocks was, whatever it was, 50%. And then they say, I can afford to be wrong a lot, because if I get some of those spikes, I will turbocharge the Fidelity Technology Fund, and I will do very well. So what did they do? Then what happened was TBG came along and said, you know what? We can take the pre-IPO round, push Wall Street out 6 to 9 months, and you'll get the spike that would have otherwise been captured by Wall Street. And you know what? We won't charge you 2 and 20. We will only charge you 1 and 5, or whatever the number is, on your money. So you put $1 billion into the pre-IPO unicorn, and you're going to capture the spike. And the mutual fund manager sitting there said that makes